Brad from Equifax. Welcome. Great to have you.
Thanks, Peter. Great to be here.
What impact has the most recent RBA decision to cut its cash rate had from your vantage point at Equifax?
Mm. Well, as you know, Equifax is a global data analytics and tech company. So we're privileged to have access to a lot of information that shows us what's happening across consumers and consumer lending, but also across businesses. And so typically when we look at changes to the cash rate, we can see that flow through into a range of things for consumers, but notably residential mortgages. So when we look at a reduction in a cash rate, like a 25 basis point reduction, and typically it takes about 9 months for that full relief, right, to sort of flow through and be seen. It's interesting though, because the last couple of quarters of late last year, we actually saw an increase in the consumer credit demand for residential mortgages. And that's the first time we've seen two consecutive increases for a long time, since the back end of 2021. And so it would suggest that there's potentially some which are already anticipating the reduction in the cash rate. So it'll be interesting to see how that plays out.
So you're saying that there was an anticipation before the actual cut. The market was kind of getting ready. Consumers were looking through and seeing the possibility increasing.
I think it's fair to say there was certainly an expectation and anticipation that there would be a reduction to the cash rate. So I think that partly can be already reflected in some of the data that we see already.
Mm,
But what is also encouraging, though, is that we've got a robust jobs market.
yeah.
And so what have we got? An unemployment rate of 4.1%, underemployment 6%, but we've got a very high participation rate, like 67%.
People are working.
They're working.
They've got jobs.
So it sort of holds the arrears rates at bay in terms of the risks otherwise prevalent. So it's good to see how it's actually having a positive impact for consumers.
What about on the other side of the ledger, businesses? We hear a lot about anecdotal insolvencies, but in terms of a trend, in terms of systemic insights, are we seeing that deteriorate or is that still holding firm too?
Yeah, well, maybe some context before we jump into businesses is looking at the other side of the equation for consumers. So while we've seen some good positive signs, there are also some risks.
Hmm.
So Equifax has also recently released its Australian Credit Scorecard, which shows that for last year, 2 out of 5 Australians are more stressed about their financial situation than they were a year ago. 2 out of 5. We know that half are really focused on sort of controlling their discretionary spending. And of that cohort, they're really looking to put in place some financial goals to move from paycheck to paycheck. How do they improve their surplus, their savings, and their resilience? And so that naturally plays out in terms of impacts to industries. So, for example, with Australian consumers and their discretionary spend, we know that 56% of consumers are now looking to try and eat more at home. So invariably that impacts their hospitality industry, accommodation and restaurants. And so, we've seen the insolvency rates in that sector over double what they were pre-pandemic levels, right? So we've seen an elevation of insolvencies across retail, notably hospitality, but also construction.
But is that elevation in insolvencies above trend, above the business cycle? Because we had a lot of zombie companies that were propped up by the pandemic relief. That natural flush out didn't necessarily happen. And then we're kind of seeing that materialize. Are the business insolvency trends normal? Are they elevated? Where's the context?
Yeah. It really depends on what sectors we're talking about. So some sectors have been a lot more pronounced than others. And so hospitality is a great example of one of those that has been really pronounced.
Mhm.
Another example is construction. What's encouraging is that in the last quarter, we've actually seen a softening of the insolvency rates, and we've been monitoring that across December and January of this year, but they're still elevated. And so even though if we talk about construction insolvencies, it was still 48% up in the last quarter of the last calendar year relative to the prior comparable period, still 48% up. So on last year. So while there's a softening or a moderation, they are still elevated.
Okay, let's dig into that construction space because one of the things that I really want to chat to you about is the iCIRT certification. Tell us a little bit about how iCIRT started, how it works, how it's grown, and the pain point it solves in that building and construction space?
Mm. Well, I think there's a lot of concerns that the market has had around construction, and maybe as a precursor, we can also reflect on what the latest Edelman Trust Barometer globally has shown in terms of the public trust to not only different jurisdictions but also importantly to different sectors. And I think and it's shown a deterioration more recently of the public trust, right? If we focus on Australia and specifically construction, there's also been unfortunately, a lack of trust across consumers and the community of the construction industry. And so about 5 years ago, I mean, there were some big catalysts here, right? So we had Opal, we had Mascot, there was a number of the media attention to a number of buildings that had defective, like significant material defects was unfortunately prevalent.
Mm-hmm.
And so there was a lot of people that came together across the public and the private sector wanting to work together in order to lift capability and to lift confidence in the construction industry. And that was the origin of the independent construction industry ratings tool. Bit of a mouthful. So iCIRT, as the acronym for short, was really put in place to help elevate the transparency and also the confidence across those in industry that are doing the right thing, that have been able to evidence their capability, their capacity, and their willingness to do the right thing, to honour their obligations. And that was really the intentionality behind iCIRT, was to address the concerns that purchasers, that buyers, but also funders, insurers, regulators, government agencies, and industry at large had when engaging with the construction industry.
Now, I'm a bit skeptical of ratings products, ratings agencies, because I used to work at one, and I worked during the pandemic on that side, and I saw how many ratings agencies got ratings wrong, particularly around debt issuance. How tight is the methodology around iCIRT? How good is it? How has it evolved? And what are you actually measuring? Is it the solvency risk, delivery risk? Tell us a little bit about that methodology.
Yeah. So perhaps for context, there is a profession that is a regulated profession in the country of licensed credit ratings agencies that have been able to obtain a license to ensure that for markets, there's the integrity, the independence, the reliability, the rigor that goes behind providing ratings in market. If we rewind the clock, about 12 months ago, we were reporting that there'd been 30% rating downgrades across the construction industry. 30% of construction businesses had rating downgrades. That's a big number. It was actually nearly double the number that had rating upgrades. And there was a lot of stress and a lot of pressure in the market. Fast forward, obviously a lot of those ratings have been evidenced to show well in advance the issues, the risks that unfortunately many were struggling with. iCIRT has shown over many years, in terms of looking at construction collapses, that more than 9 times out of 10, it's able to identify a collapsed business at least 12 months in advance,
Okay.
Or often closer to 2 or more years in advance.
Yep.
And so it's that performance, that track record, that has really instilled confidence for purchasers and buyers when they're looking to make a significant acquisition.
But are you actually rating the solvency and the financial, or the delivery? I mean, to put a box around it, what are you actually measuring? Because you may have a construction company that's financially healthy, but they can go and deliver a product that's sub-market, or the other way around. You may have someone that delivers an excellent product, but it means that they don't have their finances in order. They don't have their solvency. So what are we actually measuring?
Well, credit ratings specifically measure the financial capacity and solvency, the viability of businesses. iCIRT is more holistic. It's a performance-based rating schema that's really looking at the trustworthiness
Okay.
of constructors or building professionals. And so from that perspective, it does look at things like its capacity or its capital. But importantly, it's also looking at its capability, its conduct. What is its track record in being able to bring trustworthy built assets to market
Okay.
in terms of the design, the development, the delivery. And so what's really important when we go through iCIRT in a bit more detail is to talk about what are some of the attributes, or importantly, the criteria that's used in providing that confidence to the market. But when we designed iCIRT, it was a collaborative effort across, as it said, regulators, government agencies, funders, insurers, industry bodies, and market associations, all working together to understand what does good look like, and conversely, what are examples of bad actors, Phoenix operators, defective developments, or an unwillingness to provide compliant assets or remediate where there are issues. And so the intentionality, the design, the architecture of iCIRT was to ensure that there'd be not only resilient businesses, but those that have got the reliability, the track record of showing they've got the right quality assurance programs in place, right defect remediation activities, and a willingness, a commitment to actually make good if there are issues.
So you can't necessarily turn up as a developer and be financially strong, develop a nice product, leave the market and gain a favorable iCert rating because you're not sticking around, right? You're not there to fix defects and other issues may arise. Is that correct? Would that
Yeah.
scenario be correct?
So what would lead to a poor rating outcome? There'd be bad actors involved. There'd be parties that have left consumer harms in the
Yep.
past from defective developments. There'd be those that haven't shown a willingness or a propensity to actually remediate or engage proactively to address issues on site. Those that have got really poor records, or those that don't have the operational resources or the financial resources. Those that are engaging with other parties in that sort of build team, which also represent significant risk. And so it's a holistic assessment looking at a range of factors to really identify and discriminate those that are exhibiting high risk characteristics versus those that are exhibiting more trustworthy behaviors.
How do you get rated? Who pays? How does the financial element work around getting rated?
So the primary model that we've introduced as a part of our go-to-market proposition is a voluntary regime that enables industry to volunteer, to participate, and to go through an independent review process in order to obtain their rating. And so they're our client. They would engage us. They pay in advance. There's a range of protocols around independence and integrity. And then they have the election to determine what do they do with that rating outcome. Do they then publish that? Do they socialize that? And there's a range of protocols around the dissemination or disclosure of ratings as a part of that process. So they have the opportunity to choose. There's also counterparty ratings. And so that's where we'll have, as an example, funders or insurers or government agencies or regulators, which can also engage directly and obtain ratings on various businesses. And so there's a range of models that are available. And the primary one, which we've really tried to support industry early in this process, is to avail them access to obtain their own ratings well in advance of other market stakeholders starting to utilize those services.
So if a developer comes to you and pays to get rated and you rate them unfavorably, and they choose not to publish that, does that stay in a database where someone else can come and access that? Or is that not disclosed because they chose not to?
So where they've shared with us information that's confidential or commercially sensitive, that information is quarantined and not used.
Okay.
And so for the purposes of the rating that they would have seen, that's their property and how they choose to use it. But if they do choose or elect to disclose that, there are protocols which we have in terms of being able to verify and validate what they're communicating to the market. So whether it's selective disclosure or whether it's a publication. On the flip side, it's also helpful to know that those that have actually got, let's say, an unfavorable rating outcome are able to understand and identify what are some of the rating constraints, what are some of the limitations that might have inhibited a stronger rating outcome.
Yep.
And so when we look at our data, we see that there's nearly 90% renewal rate. So for those that have approached us to obtain their rating, come back to try and obtain an updated rating. And in all of those cases, they're coming with evidence to say, this is how we've strengthened our controls environment. This is what we've done to improve our overall governance. This is what we're doing with on-site supervision or our QA programs or our customer complaints or our remediation activities, or they're providing evidence as wanting to demonstrate that they've lifted capability and to improve, hopefully, a stronger ratings proposition.
From your vantage point and your experience, do you think the media sentiment around brand new property that we spoke about earlier was justified? Or do you think it was overblown? And what percentage of the property development industry do you think are bad actors? Um, Fact versus myth.
Mm. That's a good question. When we came together, it's fair to say, there was some very heated views around the extent or the prevalence of those across the industry causing harm. So on one side of the camp, you would have market associations that were saying the sky's falling. And on the other side of the camp, you'd have industry saying there's no problem here. But I think that when you look at the data, which was a collective effort of what does good look like, or conversely, what are attributes that are higher risk
Mhm.
in nature, we found that about a quarter of industry overall were not able to attain the minimum threshold or the eligibility of earning their trust credentials. Now, that doesn't mean they're all bad actors.
Yeah.
It just means there's aspects within their businesses that they're able to work on to, whether it's across their controls environment, their governance, their contracting, their financial well-being, whatever it may be, before they actually earn the ability to obtain that minimum eligibility of a trustworthy outcome.
And where would you estimate that is now? Is it still at 25% sub benchmark, or is that improved?
Yeah, we're looking at about 27% at the moment.
Okay.
And in terms of the again, coming back to where we sit today, so I mentioned earlier, 12 months ago, in terms of credit ratings, we saw nearly twice the number of downgrades to upgrades. Equifax is about to release some new research, which actually shows how that's evolved. And I think your audience and other members will see that it's actually now starting to show a much higher level of stability. So for every downgrade, it's closer to every upgrade as opposed to what it was formerly. Now, having said that, in the residential building space, 12 months ago, it was 6 downgrades for every upgrade because the pain or the pressure is not felt universally across all sectors within construction. So civil, infrastructure, much more resilient. Even construction services are more resilient. But a lot of the pressure has been felt across both resi and non-residential or commercial construction. And so for residential constructors out there, 12 months ago, a quarter of them were reporting net margins of below 1%.
Hmm.
Very skinny margins.
Yep.
We saw a doubling of how many were reporting trading losses relative to the year prior. We saw a doubling in terms of those reporting negative cash flows relative to pre-pandemic levels. And so there was this extended build times were having a direct impact on their cash reserves, their liquidity, their balance sheets. The good news is, and again, Equifax will be releasing some research which will be hopefully informative to your audience, that's showing how things have evolved since then. And so some early insights will be things how trade payment performance is improving across the industry. So where construction businesses or building professionals are working with suppliers, how late are they in paying beyond their credit terms? And so the good news is that's really come back. We've seen that really reduce back from 2 years ago. It was particularly high, still above pre-pandemic levels, but there's a much more confident sort of trading payment performance on average across industry. So that's good. We also see with the recycling of the order books, so they've been able to work through their project pipeline, and now the projects on their books are more profitable than those that they've had to work through in the past. And so we're seeing that sort of stabilization between the rating downgrades and the upgrades, which hopefully will be reflected in that ongoing softening of the insolvency rates across the construction industry.
I'm glad you touched on some positivity. What else are you optimistic about this year that you see from your vantage point that you think our audience may not see or isn't necessarily communicated in the mainstream? Where are your other signs of optimism for this year?
Look, I think what's really encouraging is the fact that there is genuine goodwill across a wide range of stakeholders and industry. I mean, industry has really demonstrated leadership in embracing the problem, embracing the challenges, and working hard and collaboratively to overcome those and to really restore confidence across consumers. We worked with YouGov last year in terms of consumer research. What's the impact of consumers and consumer sentiment around the construction industry versus 12 months ago? And that's really encouraging data. I mean, what we saw that for iCIRT aware buyers or investors of property, 81% of them reported confidence in construction. That's a massive number.
Mm.
When you think about that overall, there's only a third of Australians with property intentions, those looking to buy, build, or renovate in the next 5 years, which is half of all adult Australians, only a third of them have confidence to move forward. So to see the way in which industry are embracing ratings tools and really helping use those to lift confidence is really good. We've seen with buyers and investors as an example, those that are aware of iCIRT, 69% of them have reported an improved perception, their confidence of construction, versus only 7% that were unaware of iCIRT or ratings tools had reported an improved perception in their confidence in construction. 7% to 69%. So it's having a direct impact, helping lift confidence. And so it's great to see the way in which industry is embracing iCIRT. We've got, in New South Wales, we've got more than 35% of all medium and larger residential builders or developers which have been iCIRT rated. That's really encouraging, so strong traction. We see across consumers, so for those looking to buy or build or renovate, there's about 32% awareness. So we've still got some more work to do.
That's pretty good. Yep.
We've got more work to do. It was 23% a year prior. So it's great to see that growing awareness. And what's also encouraging, Peter, is we see that similar levels of awareness across Queensland, ACT and Victoria. Victoria is a little bit lower. Queensland's kind of on par with New South Wales. But there's that growing desire across the public for that trust and confidence. When we looked at what are the key issues that buyers or investors have when they're looking at buying into residential property, apart from affordability, there were three big ones. One was building quality. 85% of buyers or investors are really concerned about building quality. Two, builder solvency and or distressed builders cutting corners and doing the wrong thing. And that was 80%. 80% of buyers and investors. And importantly, 90% or 9 out of 10 buyers and investors are looking for trust, independent sources to be able to trust. So sophisticated investors are moving well beyond, glossy brochures about what they're buying. And they're really looking to, under the hood, what's the reliable, independent way of verifying, of validating the bona fides, the credentials before they outlay a significant amount of money.
Brad, if I was to buy a brand new apartment or a brand new home today and I wanted to get my hands on an iCIRT certificate or an iCIRT rating, how do I do that? Do I request it from the builder and the developer to send to me, or can I purchase it? How do I go about getting it?
Ask directly of your developer or your builder. Ask them for their iCIRT rating.
And then how do I make sure that that iCIRT rating is legitimate? Because we're in an industry where there are certain characters. How do I test that to make sure it's genuine and up to date? Because they do change from time to time, right?
Yeah. Look, it's a good question, because there has been too many cases where some builders or developers have been misrepresenting that they've actually earned or obtained their iCIRT rating credential. And in fact, there's been some media coverage across tier 1 media publications around the fact that there have been some misrepresenting. So what's important for buyers, investors to know is that when their developer, when their builder has an iCIRT rating, they'll have a QR code or a URL that enables consumers to go direct onto the iCIRT website and to put that in order to verify and validate directly with the source that is true and legitimate. And so it's good to know that there are mechanisms in place that are available to help consumers verify and validate.
I think it's a good idea also for solicitors and conveyancers who are acting on behalf of purchasers. They look at the draft strata plan, they look at the levies, look at the iCIRT, request it from the vendor solicitor, and then validate it and make sure you're actually going to the right link, right?
Yeah, absolutely.
to the right iCIRT link and checking that schedule. Mate,
just on that, actually, there was one of our tier 1 law firms was actually working with the government early in this process and put in place some draft contract clauseware where they were encouraging purchasers, they were encouraging buyers to work with their conveyancer or their solicitor to put in place clauseware in their contracts that if they were buying a house and land package, or if they were buying an off-the-plan development, to ensure there was a clause that gave them the opportunity, heaven forbid, that their developer, that their builder was not able to obtain an iCIRT rating or a trustworthy credential, that it gave them the opportunity at their election to cancel the contract and receive their deposit monies back. So it empowered empowered buyers, right, with that process. So for industry, it's also good though, because it's having a direct impact on funders. And so in a market where, and what is encouraging is that we know, again, there was a DCM survey, capital market survey last year across 100 funders in construction or real estate development, finance and funding. And of that, 90% had reported that they were looking to grow their loan book in this space. 90%. In fact, half of them were looking to grow more than 15%. So that's big growth. Having said that, there was also the recognition that there are risks that remain. So 82% of funders were all reporting the way in which they were strengthening their due diligence as a part of construction lending or investment. Now, the problem, of course, is that delays the process. And we saw that there was a blowout. So again, the DCM survey showed that it was 50% longer from prospect to settlement to close a deal. So it was taking longer to fund.
Yeah.
What we do know from that survey, though, is that a third of all funders in New South Wales were already using iCIRT. We know another 19% were putting it in place in the next 6 to 12 months. This is last year.
Yeah.
So that's more than half of all funders now already using iCIRT in their process. And we know that for those that were using iCIRT, 43% of loans or investment they declined were because the business wasn't rated or it had a poor rating outcome. So for those that have got their iCIRT credential, we've also heard feedback from funders that it increases the attractiveness of that loan product. So it's more competitive in bidding for that funding, which creates more favourable rates, and it supports improved liquidity and speed of access to finance. So it's really encouraging that industry can see not only are they actually improving confidence across purchasers and buyers, where 8 out of 10 are prepared to pay more to know they're engaging or working with a rated, a reliable, trustworthy building professional.
Yep.
But it's also having a direct impact for funders and insurers.
I think positive incentives are the way to go.
Yeah.
We have to incentivize people across the whole economy to do the right thing, and that doing the right thing is actually good for business. And this is a perfect example of that. You touched on something really important, and I want to wrap with this. You touched on something earlier that you were surprised that the majority of the people in the industry have good intentions, that there is generally an environment. I'm paraphrasing, right? I'll let you summarize this. But what have you learned as yourself, as a leader? What have you learned working with this industry, and what surprised you, and what do you take away?
I think what I've been surprised about is the way in which industry has really embraced something that was pretty confrontational. The introduction of a rating scheme across an industry which historically has been quite opaque. There's been a concern about sharing commercially sensitive information, confidential information about their businesses. Some of these businesses have high net worth individuals behind them and are very private people. So what's been really encouraging is the way in which there's been that openness to go through this process, and it is somewhat rigorous, to evidence their credentials as a part of that, where they've been working together with goodwill to lift, to rise the boats, right? To raise the bar, to improve the whole industry for the common good. So I think that's been really encouraging to see the way, and we've been fortunate too, by the way, for the way in which industry associations have also been very, very supportive. The likes of UDIA, the likes of MBA in New South Wales would have a lot of support, a lot of engagement, recommending their members actually go and obtain their iCIRT rating credentials, because it's in their members' best interests. When you start doing the math and thinking about the way in which it can actually support those leaders across industry, doing the right thing, leading by example, as you were sharing a moment ago, they benefit from the economic privileges of being able to demonstrate their credentials. So I think I've been really encouraged around the number of real leaders across the industry that are really working hard to support the well-being of their entire industry.
Brad, thank you very much. Great insights. Thank you for lifting the standard in an industry that's very important. We do need to increase our housing supply. We do need to make sure Australia is a country where people can live, work, and enjoy the fruits that we've built. Housing is an important part of that, and integrity in housing is perhaps the cherry on top. So thank you very much for joining us and for your insights and your great work.
Thanks very much, Peter. Much appreciated.
Thank you.